Peter Rose, Longwood Currency Trading. I'd like to chat a little bit about the problems involved in doing computer analysis simulation modeling on currency trading. My background is not only real estate investment, but also I spent 33 years as a computer software engineer doing complex business applications programming. And I applied that. I mean, I've been doing programming since I was in basically a freshman in college a long time ago, 68. And so I have done a lot of simulation of a lot of different problem domains. And I've been doing, I've done stocks, I've done commodities, stock options, and then since 2007 or 8 or so, when I first heard of the currency markets, I've been doing various kinds of simulation analysis on the currency market. So I've got quite some experience in doing that. Here's the problem. I'm doing a simulation right now, as a matter of fact, and what I'm studying in this particular simulation, I may do a video on that, but this particular simulation has to do with determining the viability of random price motion and using static stops and static stage out take profit positions, and what happens with enormous numbers of run, what are the metrics of doing that from a simulation standpoint. And I've done a lot of stuff like that, but I've also done a considerable amount of simulation based on indicators. Like, I'll give you an example, because it's the classic one that people, anybody who knows how to computer program has probably done a moving average crossover system and tried to program that. And here's the problem with that. You know, you're crossing, let's say you're doing a long transaction. So when the fast MA crosses up through the slow MA, that's a buy signal, and when it crosses down through the slow MA, it's a sell signal. So you're always in the market one way or another, because you can do a reverse on that. So in other words, you go long when the buy signal, when the short crosses upward through the slow, and then you close that position out when the fast crosses down through the slow, and you open a new position, a short position, going the other way, and you do that. And you know, it works great as long as you've got a fairly long trend to pick up a large win. But if you have any kind of chop in there and you're using the incorrect moving averages to do that, then you end up getting sliced completely to shit when you do it. So the viability of a moving average crossover system is going to be regulated by the ATR of the particular currency pair that you're trying to simulate, as well as the you'd call it the periodicity of where those two lines cross on the waveforms. And when you get into a chop, when price is running linearly, bouncing off two boundary condition lines, for example, support and resistance lines, those are called boundary conditions, and when price bounces back and forth between those, you don't have a trending system. Well, you do have a trending system, but it's short, and it's measured within the boundary between the resistance line and the support line. And if that's 30 pips, you're going to get killed on a moving average crossover system. I don't care what you're doing. You need a couple of hundred pips or so in order to get a trend within that going, so that you've got some slot room to calculate with. The issue with doing computer simulations is that because it's so precise and it can nail it right on the head, then even when you have a trendy, a market that's in a channel or a zone between the resistance and the support line that's relatively narrow, so your trend periodicity is relatively short, the computer, because it's so exact, can pick on that, and you'll get positive results when in real-time trading you probably wouldn't be able to do that. In fact, I've proved that more times than I care to admit. And even over the long run on computer systems over a variety of volatility, I think supported through the ATR, or just the length of time that the particular trend is going to run, you can get a fairly decent return. And the problem is you need to run real-time prices against that program, because the assumption is it's running, the simulation is running over 300 or 400 price candles or whatever. So if you're trading on a oh boy, you'd have to be trading on a 15-minute chart anyway to do that. You could trade 5-minute, but I mean, look, 300 15-minute candles at 300-hour 300-hour candles. That's a long time. You know, that's 10 days that you're going through. And are you going to be at your computer to take advantage of the volatility on a pair that opens at 2:30 a.m. Eastern Time, and you have a tremendous amount of volatility? Are you going to be sitting at your computer to take advantage of those price actions? Moving average crossover systems, as is any type of system that you could program in a simulated environment, is very, very difficult to implement on most trading platforms. You know, you can have a robot, and but you got to write the robot, and you got to write the code in order to operate on that incoming data. It's a really complicated process. I mean, I did that. I know what I'm talking about. Thousands of lines of code to go out to the platform or the broker's thing, bring in a feed of current prices, and take the last price that was there, put that into your simulation, do all your conditional logic against that price. Does it meet the criteria of a crossover? Should I do this? Should I not do that? And you got to go out and poll that so that you're doing it almost on a 5-second time frame basis. Because if you're doing it waiting for a crossover on a 5-minute bar chart, that you're going to be hurting. You're going to because where the crossover event occurs is not the price at that particular time. That's just where the moving averages cross. So that crossover point is a cross between an 8-period moving average, or the average over the last 8 periods, as opposed to where it's crossing over where it was over the last 21 periods or 50 periods or something. So your actual price at that point could be, well, if you're on a 15-minute bar, a 1-hour bar, you could be 40 pips off. You could be 40 pips off as to where the actual price is when the crossover event occurs. So you got to be really, really, really careful. And if you don't know what the fuck you're doing, you can't implement an automated system like that by writing it yourself, or getting a robot that you could program in order to do that. Because if you're not a programmer, I don't care what the robot guys tell you, you're not going to be able to get this level of sophistication on your own. You'd have to buy the robot and say, I need this particular implementation system involved. If it's simple, like a moving average crossover system, any dumbass could program that for you. But none of those systems really work, because they're all based on all kinds of indicators. You have to base it on price action. Those are really complicated. I mean, I had rules that were hundreds of lines of code in order to execute that rule against the current price action. Here's what I did, is I took all of the prices back, like 300 prices, and I'd run a simulation against it. I'd run a series of simulations against it, at different, for example, for moving average crossover system. I'd run the simulation based on an 8 cross 21, then I'd base it on an 8 cross 34, then I'd base it on a 21 cross 50 and a 5 cross 8, and then I'd look at the results of that. I'd accumulate the results of that, and I'd say, well, over this past period of time, the best moving average crossover system was this one, that 21 cross 34, or the 20, I'm sorry, that's too short, 21 over 50. And then I would go back and I would execute my order decision process based on what's happening on 8 or a 21 cross 50. I mean, does your head hurt? Okay, it's thousands of lines of code. Unless you're really sophisticated, you're not going to be able to do it. And for all the work and the grief and the aggravation that it takes, the platforms change the format of their data feed that gets out to you. It's very, very difficult in order to use the broker's API, their application programmer interface, in order to go in and get the data that you want and bring it back, go through the time frames of that data to put it into your own database to make it make sense. Don't even think about it. If you're trying to develop a system that will tell you whether a moving average crossover system is good or not, you've got to go in and only use that system against the time frames that you're going to be sitting at the computer. So you go back and you get, let's say you're going to use a moving average crossover system on a 15-minute chart, and you're only going to be trading between the hours of 2:30 in the morning Eastern Time to 11 a.m. Eastern Time. So you've got to go back and get your data sets over the last 30 days that are just between those time frames. And you're going to have to run your simulation against those data sets just during that time frame in order for you to determine, well, while I'm sitting at my computer, the probability of me hitting this particular configuration is pretty good. But you can't take results from a simulation when those results were figured in at, I don't know, midnight to 2:30, because you're not at the computer then, or, whatever. You can't filter those in because they'll skew the results. You get the picture. So those are the problems in using a computer program to simulate what you're trying to figure out. You know what the simple answer to that is? Look, I got a degree in physics. I've had a long career as a software engineer, 33 years doing this stuff, and I've been programming against this kinds of data probably since 1974, okay? Here's the simple way to do it. Don't fucking worry about it. Learn how to trade, for Christ's sake. Learn how to trade. Sit down at the computer and use your knowledge to trade based on what's going on during the time that you're sitting there at the desk. Don't go relying on what somebody else tells you. Oh, when you've got a average true range of X, then you can use a moving average crossover system that's the blah 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 and blah, because it doesn't make any sense. It doesn't matter. It doesn't matter. The only reason that you would use a simulated environment is to get a better idea of the probability that certain things may occur during certain time frames based on past data. That's like looking at the traffic pattern between 8 a.m. and 9 a.m. in downtown Chicago, when you're going to be trying to get from your house on the south side to, I don't know, North Beach or something. And so you do that traffic pattern analysis at 2 o'clock in the morning and all the way through. What good is that going to do you when you're actually going to go in there at 8 o'clock in the morning? You're going to have to do that analysis with data from the time period that you're there. But why bother with that? Why not just dial in the radio and listen to what they have to say? Oh, geez, Lakeshore Drive's kind of plugged up right now because there's an accident by Buckingham Fountain or something, right? And so you say, okay, well, I got to give it another 20 minutes then. Do the trading the same way. Act on current information. Don't be getting your bowels all in uproar over what happened in the past. Because what happened in the past is done. It's like a rotted apple, you've thrown it out. You're not worried about the rotted apple anymore. It's done, it's over. Take the apple that you have, take a bite, and enjoy it. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.